Your 20s are the most important years when it comes to building wealth. Those who figure this out early often end up miles ahead financially of those who don't. But why would you listen to me? Well, I'm actually still a student myself. I'm currently in the final year of my master's in finance, and I managed to build a $20,000 portfolio. That may not sound like a lot according to what you see on social media, like 17-year-olds that own 3 houses, but at least it's realistic. And I'd say that's pretty good for a student without a steady income. In this video, I'll share the exact step-by-step plan that I followed to achieve this goal so you can do the same. This is not financial advice. I'm just sharing how I did it and the mistakes that I made along the way. Also, I'm curious, if you're also investing right now, then feel free to comment down below your age, the size of your portfolio, and any mistakes that you made along the way. But now, let's get into it. So if you are in your 20s right now, then I want to start by saying congratulations, because you're already doing something that most people delay for years, which is learning how to invest. And to show you why this is so important, I'll give you an example. Let's compare 2 people that both watch a video about investing. The first person is a student that starts investing at the age of 20. The other one wants to wait until he's graduated and starts investing at 25, which is, by the way, still a really good age to start investing. Let's say they both invest $500 a month until they are 55 at about a 10% yearly interest rate, which is the long-term average of the US stock market. If I put these numbers into an online interest calculator, then you can see that the person who started at 20 will have a portfolio of about $1.7 million, and the person who started investing at 25 will have about $1 million. Take into account that this is before transaction costs and before any potential taxes, depending on your country. Now, of course, these are both really good numbers, but notice that with only 5 additional years of investing, person 1 has almost doubled the portfolio of person 2. This noticeable difference is all because of compound interest, so the most important step is to start early. But even if you're in your 30s, 40s or 50s, the best moment to start investing is now. Don't try to wait for the perfect moment, because that moment will never come. But before you even think about investing, there's one thing you need to do first, which is clearing your debt. This is the first step to building your portfolio. And when I say debt, I'm not referring to student loans or a mortgage. Well, it's very unlikely that you have a mortgage at this age, but I'm talking about high interest debt, credit card debt for example. If you currently owe $500, $1,000, $2,000 or even more in credit card debt, then I can say with almost 100% certainty that the interest cost on that debt is really high. Remember the example I gave earlier about the effect of compound interest? Well, this effect can also work against you. If you owe high interest debt, then it's going to be really difficult to build wealth in the long term, because the interest you're paying can easily wipe out almost all of your investment returns. It's kinda like trying to fill a bucket with a hole in it. It's not going to work. But if you have student loans, like most students do, then you can absolutely start investing. But make sure you have a plan to pay that debt off over time. This brings me to the next step, which is building an emergency fund. The biggest mistake that I made when I started investing was not building an emergency fund. This means that you save about 3 to 6 months of your living expenses and put it on a high yield savings account. It should cover things like rent, student loans, groceries. It kind of functions as a safety net in case something bad happens, like your car breaking down or losing your job for example. And yes, I promise you, those things will happen. The last thing you want is to be forced to sell your investments because your car breaks down. I've actually been there myself. I was naive, didn't have an emergency fund, and I literally had to sell a part of my portfolio just to pay for a freaking speeding ticket. It's really embarrassing now that I look back at it. Okay, now let's get into the actual process of investing. Once you've built an emergency fund, it's time to choose a low-cost broker. A broker is basically the platform or company that allows you to buy or sell things on the stock market. But not all brokers are the same. When choosing a broker, one thing you want to pay attention to is transaction costs. These are the fees you pay every time you buy or sell something on the stock market. I'm not going to spend too much time on brokers here, because the best one for you depends on your personal situation. But I have a playlist on my channel where you can find the brokers that I personally like. Now we get to the most important question. What do you actually invest in? Again, this is just my personal approach, not financial advice. First, here's what I'm not investing in. I would never buy meme coins or do day trading or anything like that. I'm not saying there are no profitable day traders, but 9 out of 10 times they make their money from selling a course and not the trading itself. I'm more focused on the long term. One of the biggest advantages I have, and you probably as well, is time. Since I'm young, I can afford to take more risks than someone who is approaching close to the retirement age. My goal isn't wealth preservation, because I don't have any yet. The goal is creating wealth. That's why I'm not investing in things like gold or bonds, for example. They can certainly have a place in a portfolio, but they are mostly for protecting wealth, not building wealth. Actually, I made a mistake of investing in gold. I remember that at the time it sounded exciting and smart to own, but historically, there have been long periods where the price of gold didn't really grow at all. So I asked myself the question, do I really want to own an asset that might not grow for decades? The answer was no. As a beginner, I also really value simplicity. I don't want investing to become a second job. I don't want to spend hours every week doing market research, trying to predict which specific stock will be the next big thing. I have other things to do, and I want my investments to work in the background while I focus on my career. That's why I went with ETFs. ETFs, or exchange-traded funds, basically allow you to invest into a collection of companies at once. A popular example is VOO, which tracks the S&P 500. These are the 500 largest companies in the US. I know that ETFs aren't the exciting answer, but for my personal goal of building wealth over the long term, they tick all the boxes. Potential for high returns, they are much less risky than crypto or individual stocks, for example, because I'm investing in hundreds of companies with one click. And most importantly, they keep things simple. I really hope you got some value out of this video. By the way, I have a playlist on my channel of the ETFs that I'm interested in. Subscribe if you want to see more videos like this, and hopefully, until next time.